Good afternoon. Shares in Asia rose as tensions appeared to ease between Russia and Ukraine, boosting markets. Meanwhile, investors reacted to weaker than expected Chinese inflation data. Japan's Nikkei jumped 2.25%. European markets inched higher as investors assess the geopolitical outlook, while corporate earnings season rumbles on. Meanwhile, as inflation runs hot, Wall Street is looking ahead to the minutes from the Federal Reserve's January meeting, which will be released this evening at 9 p.m. South African time. To give us more perspective on how all of this is playing out on our local markets, we are joined by Carmen Mpelwana, who is from ABSA Asset Management. Carmen, thank you so much for your time. I mean, given this risk-on approach that we were seeing with the Asian markets, especially when we take into consideration what's come out of the Russia-Ukraine scenario, is our JSE also feeling that type of sentiment flowing through?
Yeah, we've actually seen an uptick in the market to midday today, so up about 67 bips. And that's largely been driven by the resources sector. As you've mentioned, they are entering results season. And then we're also seeing an uptick in banks and retailers as well.
So let's talk about, some of the companies that you're going to be paying attention to, especially locally as we get into results season. Some of the banks have given us trading updates, and we've also seen trading updates from the food retailers. What will you be looking out for, and which company will you be paying attention to?
Okay, so definitely going into resources sector. All of them will be coming out between now and about the mid-March. And so we're looking out for what the outcome is there on earnings, number one, as we all would do. And then specifically on the banking side, as you've mentioned, Nedbank came out with their trading update earlier this week and giving an indication that there's been an improvement in the climate in South Africa specifically, and that's probably going to see a read-through for those banks that are focused specifically in South Africa. So the likes of FirstRand and Capitec as well. So definitely looking for whether we see earnings surprises to the upside, which always benefits the share price. And then lastly, I think one of the laggards that we will look for later on in the year, towards May time, will be the healthcare sector, in terms of whether there's been a recovery for them as well.
So last night, everyone was digesting the hot U.S. PPI figures. And given what we've seen with the U.S. CPI print, some are still betting on the fact that the next CPI print just before the March Fed meeting could also be higher. How are you expecting the Fed to read into all of this data coming through, especially for March?
Yeah, so if you go back slightly, as you mentioned, PPI numbers came out and those were ahead of consensus. Consensus was looking for year-on-year 9.1%, but we saw it come in at 9.7%. And as we know, as we've seen over the last 12 months, this has largely been driven by supply chain issues, number one, an increase in oil price, number two, and in the US specifically, there's been a labor crunch. So those have been significant tailwinds to PPI, number one, and therefore the expectation is that's likely to continue with CPI going into March. The expectation or the sentiment is that based on these high inflationary numbers, there's more credence behind an argument for the Fed to increase interest rates, which we expect them to do starting in March. The market has priced in a 6 interest rate hikes for the rest of the year. So this just gives some more sentiment in terms of that.
What do you make of the concerns around a Fed policy misstep? Is that also part of your concern?
At the moment, it seems to be 50-50 on consensus, whether it's going to be a 25 bips hike or a 50 bips hike. At the moment, I am more cautious, so I would go with the 25 bips and rather ease it in that way and allow the economy to adjust accordingly.
Which sectors are you cautious about, especially as a lot of the central banks are moving towards policy normalization and tightening?
I think one sector that we remain very, very cautious on is, number one, the food producers. We've seen a significant sort of pullback across that sector. But more importantly, I think for the the discretionary sectors where the consumer who's going to be under pressure going forward is likely to spend their wallet in a different way. So that's definitely one one sector to have a key concern around. But having said that, within the retail sector and clothing retailing specifically, you've got to split it out into the different income levels, because there are definitely different dynamics in terms of how the consumer spends and how much under pressure they will be going into the tightening environment.
Before I let you go, key events that you're going to be paying attention to for the rest of the week.
So definitely keeping an eye on the Ukraine-Russia. It seems to be that the world is now thinking that Russia is just posturing, and that we should see them sort of pull the troops back from the lines at Ukraine border. And then also, maybe not in the next week, but in the next few weeks, to keep an eye out on the virus. The virus is not gone yet. The pandemic is not gone yet. And one of the key concerns is around whether the opening up of economy will remain so, specifically in the Northern Hemisphere, or whether a new variant will stem that.
All right, Carmen, thank you so much for your time. That is Carmen Belwana from Absa Asset Management, giving us her perspective on market dynamics. We're going to take a quick break. When we come back, we'll look at retail and CPI figures. Stay tuned. The retail sector is showing some signs of recovery. Retail sales increased by 3.1% year-on-year in December 2021. The main contributing factors to the increase were retailers in clothing, textile, footwear and leather goods. Retail sales increased by 6.4% last year compared to the previous year. Meanwhile, consumer inflation is slightly in January thanks to the fuel price decrease in the month. The annual consumer price inflation was 5.7% in January, down from 5.9% in December. The price of petrol decreased by 68 cents per litre last month following continuous increases sparked by the high oil prices. The main contributors to the 5.7% annual inflation rate were food, non-alcoholic beverages, housing and utilities, as well as transport categories. Consumer food price inflation accelerated to 6.2% in January from 5.9% year-on-year in December. Oils and fats, vegetables and meat are the primary products underpinning this uptake in the overall consumer food price inflation. Economists say production costs as well as supply chain constraints have caused food price increases. Electricity and other administered prices, global producer prices, food price inflation and elevated oil prices pose upside risks to inflation going forward. The Reserve Bank expects inflation to average 4.9% this year. Earlier, the rand inched higher in early trade ahead of the consumer inflation and retail sales data. But for more, we are joined by Ganti Paya, who's an economist at Nascent's Advisory and Research. Good afternoon, Ganti. Let's start off with the retail sales figure, which I just read out there. Was that in line with your expectations?
Look, I think, we know that these are numbers that reflect actually some of the recovery that we are seeing. I think we should be very careful, of course, not to read them too much, because, of course, we come from a very low base where things have actually been very, very dramatic for consumers. So one actually wants to look at this and say, look, how actually do we actually look ahead? So certainly there has been an expectation of some recovery in terms of what we've seen from households, especially as we come off this period of the festive season, as it were, where a lot of people, of course, would have been spending, and you can see the categories of what we've been spending on. But certainly, if we look ahead, there's still a lot of pressure on the consumer. We've seen some of the numbers that came out, for example, in terms of household incomes, where actually, in terms of incomes, the households are much poorer if we compare this period to what they were in the previous period. So, in terms of wages, at least. So we have to be very careful how we actually look at this as something that is much more than it is.
So, which is a nice segue into that CPA data that I just read out as well. I mean, it seemed to have been in line with other economists' expectation. However, the figure is still above the SABC's, in target band. What does that do for their decision going forward? Does it make things a little bit difficult?
Look, I mean, I think there's been quite clear that we still face a lot of inflationary pressures. You really spoke very well when we talked about some of the contributors to the food price inflation. And much of that is actually inflation that we are importing. So because we import a lot of the foodstuffs, so the issues around global value chains are going to give us, and logistics are going to give us a lot of problems because we import so much of our foodstuffs and that we don't plant, as we talked about, the oils and all of that. So that is actually something that we have to look ahead to. But also we have local pressures, right? We have local pressures in terms of of the food prices because of the disruptions we've seen in terms of the rains, and certainly the oil prices and the fuel prices locally have increased somewhat since that last decrease that we were highlighting there. So if we look ahead, there's still a lot of pressure that may be coming in terms of inflation, even though that is not at all a reflection of consumers who are trying to buy more and therefore what we call demand-driven inflation. So the consumer itself is still under pressure. But if you then read what the Reserve Bank and some of the economists have been saying, is that what they're looking at is concerned about interest rates from other countries that may influence the South African rand and that may actually add more pressure. So this is something that the Reserve Bank is looking at. And I think looking ahead, they would have been able to see that pressure which they were worried about still very much exists, even though there's been this slight moderation in the last print of inflation.
While we're on that, before I let you go, there's a lot of conversation in the US about whether it should be 25 basis points in March or even 50 basis points. And you get some Fed presidents saying that, at least 100 basis points should be able to stem inflation. I mean, what will you be paying attention to in that March meeting?
That's very much the question, and we've really outlined it very well, because that's the big concern. Because as interest rates start to increase in the US and other countries, what they call carry trade, which is really about people looking for that extra interest rate yield, they may actually start to think about taking that money away from South Africa and into the US. And that is really what has concerned the Reserve Bank and many others who are looking at this, because that may be the pressure in terms of the rand, where people are starting to look for that extra interest rate that's coming out of the US. So that is a number that everybody's watching, because it gives us these concerns around which the rand may weaken and then deliver more inflation, because the weaker the rand is, of course, the more actually it is expensive to buy goods that we import. And as I said earlier, we import quite a bit in terms of the food. Of course, we don't have any oil in South Africa, in terms of which we actually grow our own. So those pressures in terms that can come through a weaker rand is what everybody is very concerned about. And that's directly linked to what you've just explained around the US interest rate.
Kanti, thank you so much for your time. That is Kanti Pai, who is an economist at Nason's Advisory. Moving on, Cape Town Mayor Jordan Hill-Lewis has again reiterated the city's plans to do away with load shedding. The city will be working with independent power producers to supplement its electricity supply. Hill-Lewis was addressing the opening of the Solar Power Africa conference. SABC News reporter Mariska Botha attended the conference this morning.
The Mayor of Cape Town, Jordan Hill-Lewis, wants to ensure that this city becomes the first major one in South Africa to be load shedding free. In order to do this, he announced this morning that the city has opened up a procurement and tender process for independent power producers to supply electricity to the city of Cape Town. Now, the city of Cape Town uses around 2,000 megawatts of electricity per day, and Hill-Lewis says the aim is to generate 300 megawatts of electricity through this process with independent power producers. He says it can be big companies, it could be a number of small companies coming together, and that the city is open to any suggestions, proposals and discussions from independent power producers to supply energy to the city. Now, he says the time frame for this is around 40 to 50 months from the tender process to construction and then the supply of this electricity. Now, of course, the Minister of Mineral Resources and Energy, Gwede Mantashe, was also present here, and he said there is no way that any city cannot be reliant on Eskom. Hill-Lewis agrees with the minister, saying that the aim is not to get energy from Eskom, but to become less reliant on energy from Eskom and to ensure that the city becomes load shedding free. This in order to grow the economy, create jobs, and he says the only way to ensure that an economy is thriving is to have a reliable and secure energy source, and that is the aim of the announcement he made this morning. The Minister of Resources and Energy, Gwede Mantashe, also saying the government welcomes independent producers to supply electricity, but Lewis says with this process they will see whether or not it is as easy as the ministry and the Department of Mineral Resources and Energy says it is to get under 100 megawatts into the system, which is the idea behind this tender process and procurement, is to get a number of IPPs in the game to supply that energy to Cape Town. And Hill Lewis says that's just the first step in a long program for the city of Cape Town towards using more and more renewable energy sources. And of course, solar energy is one of the main sources of that. South Africa and Cape Town is one of those cities that is blessed with a lot of sunshine. And as one of the speakers said here, although mining is one of the key economic drivers in the country, we should now be looking instead of into the ground, up to the sky and mine what is available to the African continent and to the city of Cape Town freely. And Jordan Hill Lewis says the time is now to get that process started and off the ground and get as many IPPs involved in providing the city of Cape Town with electricity and becoming the first one in South Africa that after 15 years of load shedding will become the first not to sit with the burden of that, to allow business to grow and create more jobs and to grow the economy.